We are simultaneously witnessing the emergence of a $3.4 trillion unified market designed to be a magnet for global capital and a counterweight to global trade uncertainty. Welcome to the African investment paradox.
And the dramatic collapse of sovereign stability in key regions where political chaos triggers crippling sanctions and financial isolation. We are tracking a radical, real-time divergence, a stark choice between continental integration and geopolitical fragmentation.
These two forces, the AfCFTA's push for integration and the sanctions pull towards fragmentation, are creating a new financial map for the continent, fundamentally redefining risk-adjusted returns in Africa.
AfCFTA, the mechanics of de-risking and value creation. Let's first establish the core financial argument for the AfCFTA. The headline is scale, but the financial mechanism is de-risking. By reducing fragmentation, the AfCFTA lowers the unit cost of market entry for global and African multinational corporations.
Absolutely. The World Bank forecasts that with full implementation, the AfCFTA could boost African incomes by $450 billion by 2035 and lift 30 million people out of extreme poverty. That's the dividend of scale. And for the institutional investor engaged in yield hunting, the data is compelling. By cutting average tariffs and eliminating up to $50 billion in non-tariff barriers, the agreement shifts FDI strategy from single-country risk to multi-country, regional value chains. It's the move from extractive wealth to manufactured wealth.
And that value is protected by the legal framework. The AfCFTA Protocol on Investment isn't just a political document, it's a legal shield. It guarantees national treatment and sets clear rules on indirect expropriation, providing the regulatory certainty that corporate treasuries demand. This single framework replaces a chaotic web of over 170 national and bilateral treaties.
Crucially, it stabilizes currency risk. The Pan-African Payment and Settlement System, PAPSS, is designed to facilitate trade in local currencies, minimizing the reliance on the US dollar and significantly reducing the FX risk that historically penalized intra-African transactions. This mechanism aims to eliminate a hidden cost that could increase the price of regional goods by up to 30%. That's a massive internal profit margin boost.
However, we must concede that the African Continental Free Trade Area is not a panacea. Its success is heavily dependent on resolving non-tariff barriers, such as poor infrastructure, differing standards, and corruption at border posts. Even in stable, committed countries, these logistical NTBS currently undermine the full financial potential.
Sanctions, sovereign risk, currency destabilization, and fiscal shock. Now let's pivot to the inverse, the immediate systemic financial crisis triggered by coups. When a coup occurs, it instantly escalates the sovereign risk premium. The price of a country's credit default swaps, CDS, the insurance against default, skyrockets, and global banks freeze all new lines of credit.
The immediate financial instruments are devastated. Credit rating agencies immediately downgrade the country, effectively classifying its debt as junk. This makes it impossible for the government to roll over existing sovereign debt, forcing them toward default or highly punitive, short-term financing.
And the regional sanctions turn that risk into guaranteed economic contraction. When ECOWAS and other bodies impose comprehensive sanctions, they deploy two devastating financial tools: border closures and freezing of central bank assets.
The border closure is the supply-side shock. For landlocked states like Niger and Mali, cutting off access to ports in Nigeria or Côte d'Ivoire is an economic death sentence. It halts trade, fuels hyperinflation, and severely curtails the state's capacity for customs revenue generation, directly compromising their fiscal sustainability.
Then comes the monetary shock. For nations within the CFA franc zone, the suspension of access to the regional central bank fundamentally destabilizes their currency peg. This not only affects government finance, but also paralyzes African multinational corporations, MNCs, that rely on intra-regional financing and lending, leading to a freeze on cross-border investment and potential job losses.
Furthermore, the Alliance of Sahel States, AES, formed by Mali, Burkina Faso, and Niger, and their withdrawal from ECOWAS is a profound geopolitical fragmentation. It reverses decades of economic cohesion, creating internal divisions that make any large-scale cross-border infrastructure investment, the very projects the AfCFTA relies on, too politically hazardous to pursue.
The investment map, divergence and consolidation. The conclusion for the institutional investor is unambiguous. We are seeing a powerful bifurcation of investment flows.
Capital is rapidly consolidating around the AfCFTA anchor states. These stable economies are benefiting from a flight to quality, absorbing the capital and projects that have fled instability. Their demonstrated commitment to regulatory continuity and regional law is now their primary economic, competitive advantage.
This consolidation means that investment in sectors like fintech, digital payments, and advanced logistics is deepening in stable economies. They offer the necessary liquidity, predictability, and sovereign creditworthiness required for large-scale long-term investments.
Conversely, the coup-affected states see their investment profile revert entirely to localized, high-risk, speculative equity, or purely extractive commodity deals where the political cost is absorbed through massive premiums. Their economies are becoming delinked from the continental growth story, facing a prolonged period of high debt risk and low investor confidence.
The investment debate is no longer about potential versus risk, it's about integration versus isolation.
Conclusion. In the final analysis, the two opposing forces reveal a fundamental financial truth. Political stability and commitment to regional law are the most valuable assets a sovereign state can possess. They are the indispensable infrastructure for all modern African growth.
The ultimate financial map of Africa will not be drawn by resource wealth or historical ties, but by which governments choose the arduous long-term path of economic integration, institutional clarity, and adherence to the African Continental Free Trade Area blueprint.
The global market has made its bet. It is betting against chaos.
And the financial consequence for those who choose otherwise is total economic isolation.